Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, July 24, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And again, we had a very light volume day, very limited activity across the market today. We're in the summer doldrums. We need to understand that. In addition to that, it's Monday. Therefore, we had a limited amount of earnings that have the potential to move the market. And that coupled with the summer doldrums and Monday all points to a very lackluster, dull day. And that's exactly what we got throughout the trading day. It was a very narrow-ranging day, and there was limited activity all day long. However, even in the summer doldrums, that doesn't mean that has to continue. What we have on the docket is an enormous amount of earnings coming out this week by the big S&P and Dow-related companies. That has the propensity to move markets depending on which one or which stocks, I should say, have earnings, whether it's on the good side or the bad side. And it's not the earnings that are good or bad. It's how the market reacts to earnings. Case in point, Google reported after the bell today, and as I make this video, it's down about $21. Now, they beat on the revenue number, and apparently they beat on the earnings estimate, but none of that really matters. It's how the market reacts to earnings. The numbers really make no difference. And so, therefore, we're seeing Google sell off a little bit, and we'll see what happens with some of the other ones that report. Tomorrow, there's a lot of earnings coming before the bell, and I'm not sure exactly which ones were after the bell today. I'll have to take a look. But we'll see what kind of impact Google has on the NASDAQ and what impact the other stocks that report in the morning have on the overall other indices. In addition to that, you have the Federal Reserve meeting this week. Their normal meeting is Tuesday and Wednesday, culminating with some kind of an announcement on Wednesday afternoon. And so we'll see what they say. We'll see what they do. I'm not sure whether they're actually going to do anything other than the typical announcement they have, which is a canned statement they pull out of the file cabinet. It's just a matter of whether they pull it out of the top drawer of the file cabinet or the middle drawer. It's always the same routine. They'll say that they're dependent on the economic data, and the economic data seems fine. We're headed in the right direction, blah, blah, blah. Inflation is tame, but they're trying to promote a certain amount of inflation. And that always has me scratching my head. I'm going to digress for a second and just get on a little bit of a soapbox in terms of inflation. I can never understand why people don't take a more interested view of why the Fed wants to create inflation. I understand it from an economic standpoint. They think that if they create inflation, then price inflation is good in terms of real estate values and asset values. But in the end, the reality is if the Fed creates inflation, we're paying more for stuff. And I don't know anybody that wants to pay more for stuff. So the Fed creating inflation is actually a misnomer. What they're actually trying to do is they're trying to stave off a deflationary environment. Deflation is bad because asset prices get depressed. The Fed doesn't want to see that because it makes it look like they have lost control. And so therefore, they flip it around and say that they like 1, 2, or 2.5% inflation. But in reality, when you compound 2% inflation over a long period of time, that's why it costs us a whole lot more today than it cost us years ago for the same things. So I don't see the benefit of inflation, but that's just me. My view is, along with a lot of other people's view, is that the Fed should let the free market work, and they never really do. They try and manipulate interest rates, and they try and manipulate whatever they can. But in reality, the market will always do what the market's going to do, despite what the Fed believes they're doing or what people believe the Fed is capable of doing. The Fed can manipulate in the short run, but in the long run, the markets are always going to do what the markets are going to do. Okay, let's get back to business, which is the S&P. So what I think is going to happen in the SPDR, and I'm going to go out on a limb here and say the market to me looks a little bit tired. When I look at the hourly chart, which I always like to do on an intraday basis, to me the hourly chart is really in a what I'll call a bearish wedge formation, right? So what we have here is we had a down move, and we're really trading sideways to slightly higher, and this will generally, until and unless we can close above the high over here, this will generally promote another down move in obviously the other direction, or the downward direction. So what I think is coming over the next day or two is I think this bearish pattern is going to play out. I think the market's looking a little tired. I think there's too many people that are what I'll use the term is complacent in the market, and therefore it's the market's job to kind of shake that loose a little bit. So I wouldn't be surprised to see the S&P or the spider come down to fill the gap that exists over here. That's normal, common market behavior. And if they're going to fill that gap, they're most likely going to test the 245.40, maybe slightly lower. My expectation is that's going to happen within the next 24 to 48 hours. If we have a larger sell that develops from there and we begin trading lower and closing lower below certain levels, namely the 245.40 and other levels that I've got my eye on, then maybe something more is going to or will develop. But it's a little early and premature to start talking about lower prices than that. Really, as far as the eye can see, I can see the market going back to retest. We'll call it the 245 to 245.40 area, and I think that's going to happen sooner than later. Let's head over to talk about the IWM a little bit. And the IWM was basically flat today. There wasn't anything going on. The IWM was down earlier, came down to test the lower portion of this big green up candle. It's not so big, but this green up candle. And then we rallied off that low, and in light volume, on a day like today, Monday, light volume, there was no selling pressure out in the market today, and generally speaking, the path of least resistance is always going to be higher absent volume and absent selling pressure. The volume on the spider today was just under 17 million shares against an average daily volume of 26 million. That's light volume, and therefore the path of least resistance is higher. However, there's nothing wrong with the IWM. There's no damage in the IWM. We're near highs. We're making a bullish consolidation pattern. We're above the moving averages. So there's nothing technically wrong with the IWM whatsoever. But if I'm right and the spider comes down a little bit, you can expect the IWM to come down a little bit and come and test down some of these lower levels. There's a consolidation area here down at 141 and a quarter, 141 and a half. That's an area that you'll find some support. There's also a gap here that I don't believe has been filled. The gap is at 140. Where am I looking here? 140.29. The low here was 140.38. So this gap still exists. So we can actually come down and fill that gap. And there still would not be technically anything wrong with the IWM. We'll see what happens over the next day or two, whether I'm right in that scenario or not. Now, the transports, on the other hand, we've been talking about these for a few days, and I've been saying that the transports could very well be the canary in the coal mine, at least in the short term, for some kind of a pullback in the markets, if not more, but at least a pullback. We have to start somewhere. And the transports have been signaling a pullback in the broader market, just nobody's paying attention except me, that's all. So the transports have been down from the highs. We were down pretty much all week last week, and we were down again today, down another 0.5% or almost 0.5%, 43 points in the transports. So to me, the transports were signaling that there's some kind of downside coming in the broader market. We'll see if I'm right on that, but I think it's coming sooner than later. I think within the next, like I said, 24, 48 hours, my expectation is we're going to see some kind of pullback occur in the S&P and the Dow. And if that does occur, I won't be surprised to see the transports come to test this pivot low down here. Comes in at about 92.50. Down in this zone is where my expectation would be that the transports find a decent level of support. So if I'm right, and we do have a pullback for the next day or two in the market, this is where I think the transports are headed, and this is where I think that you can expect a minimum of an intraday bounce in the transports. Looking over at the gold market, I think today's activity is interesting. You can see we're putting in a doji day today, and we came up short of my 1260 target. The high today was at 12.59. We came up $1 short. I'm going to have to sharpen my pencil. Today is I believe the 11th day from the low. So we talked on Friday about that was the 10th day. We had what could have been an exhaustion candle. It really wasn't. We didn't get the volume required for it to be classified, at least in my book, as an exhaustion candle. But nevertheless, we put in a doji candle today. And from this point forward, we're either going to see the gold market trade sideways, which would be building energy for higher prices, or we're going to see a garden variety pullback. And if we do, we should see the gold market, if there is a decent pullback or a little pullback at all, trade back to the 1245 area. That's this line here, and that would also provide a level of support, at least on a short-term or intraday basis for the gold market. Silver is trading very similar to gold. The charts look very similar over the last few weeks, and therefore my expectation would be the same. Either we're going to go sideways from here if we can't get up to the 50-period moving average, or we're going to pull back, and a pullback would find first level of support around the 20-period moving average. I'm going to call it 1620 for argument's sake. Maybe it goes down to the 20. Maybe it stops at 1620. In that neighborhood is where you're going to find some level of at least intraday support for the silver market. This and gold are really overbought on a short-term basis, and they do need to work off some of the overbought condition. A look at GDX tonight only because we had a decent down day in GDX, down 1.7%, when gold and silver were mainly flat. And the reason why I want to bring this up is because I think, and generally speaking it is, a tell and generally moves ahead of the metal itself, meaning GDX, which is a basket of gold mining stocks, or at least it tracks, in theory, the gold mining stocks. It generally moves ahead of gold. And when I see something like this, which is a pretty decent sell day, I would call this an engulfing candle, engulfing 3 days of upside. And that tells me that there's probably some downside coming in gold and therefore also silver. More often than not, GDX tends to be the canary in the coal mine for the gold market. Even if this just consolidated for a while and pushed higher, what you're going to find is that GDX is going to have a difficult time getting through this red candle high. This was on pretty decent volume, over 100 million shares. In fact, let me see how many shares it actually was. Almost 108 million shares that day. And when you see that, and if we do get back up into that zone, that would be an area that the GDX would have a difficult time getting through there unless it traded up into that zone and then consolidated for a while. That would enable it to build energy to trade through that area. But if we just came into that in a couple of days from where we are now, for example, it's not likely that they're going to be able to trade through that area. The high here is 23.42. That would provide a pretty good resistance point for the GDX market, or the GDX in and of itself. And you'll find that on all charts. It's not a GDX lesson. That was just a chart lesson. When you see a very large red candle or a large green candle on volume and the market's coming back to that area. So for example, this market comes back up to test the high of that red candle. That's generally going to be a resistance point. If we had a green candle, for example, take this green candle. When you see what happened when the market came in to that green candle, we saw the bounce from that green candle. Yes, we traded lower, but on the first run towards the low of that green candle, we got a pretty decent bounce from that low of that green candle, or close to that low anyway. So that works in both directions. That was on volume, and this is on volume. And generally speaking, when it's on volume, the market needs to consolidate before trading through it. And you can see what happened. The market needed to consolidate for a few days before trading lower, and then bounced anyway based on that green candle. And that's just the way the market works more often than not. Doesn't matter which chart it is. All charts work pretty much the same. Going over to crude oil, we see a pretty decent upswing in crude oil today, up almost 1.5%. We had a 2-day pullback, and now we're seeing an upswing again. We found support at the 20-period moving average. Crude looks like it wants to go higher. We're still in an upward trend for the time being in crude oil. We never did come a third time, or we didn't get that third hit, this counting the first hit, second hit, and then third hit of this upsloping trend line. So we came up short, and now we're moving higher. We will find some resistance at the 50-period moving average, which is the blue sloping trend line, but there's nothing to say that we can't trade higher in crude. We can certainly get up to the 48 and a half area that we talked about for quite some time. But the old ABC pattern that we talked about for a long time is complete, technically speaking, at least in my book. That doesn't preclude crude from trading higher. It's just complete from a pattern perspective. But there's really no trade here in crude oil right now. You're in no man's land. We're in the middle of a range. Right now, this is your top end of the current range. I guess you could say this is the bottom end of the current range. And we're just in no man's land. Either we're going to break out or break down or put in some kind of a pattern until and unless it has a clear direction that I can see. Then we just have to let the market trade out and let it do what's going to do. Eventually, crude oil will put in a pattern that we could, derive a trade off of. But until and unless that happens, just let it go. Whether it's going to go higher or lower, we're just going to let it do its thing. Going over to the bond market, which you'll find something interesting. We got back inside the upsloping trend line today. So we had Friday, we got above it, closed above it, and then today, now we're back down below. And remember, and I've said this many, many times before, and I'm pretty sure I mentioned it on Friday, we really needed a close above Friday's high to confirm that we were going to trade above and stay above this upsloping trend line. As it stands now, that didn't happen. So therefore, I still think that this trend line should be respected, and I think it's important, and I think that this market still is going to favor the downside until and unless we comfortably get above and close above this upsloping trend line on a daily chart basis. Right now, we're back below, so the only way that I can really look at this chart, this bond market chart, is this way. I see a bearish pattern that will generally play out to the downside. Until and unless we close above Friday's high, that's the way I see it. And by the way, for those of you that follow the bond market closely, and I know there are some, this is the weekly chart, and to me, this is bearish, right? This is long term, it doesn't happen overnight, but this is a bearish chart. So not to say we can't go higher. I mean, my ultimate target was 159. We didn't quite get there. We came close, but you can see why. You can see all of the chart consolidation, and there's plenty of reasons why that 159, whether or not I'm off by a few ticks or not, doesn't really matter. But you can see why this area was extremely important, or is extremely important to the bond market. And it also happens to be about a 50% retracement when you take the high from here, right? These pivot highs over here, and you have your lows down here, okay? And this 159 is about a 50% retracement, and markets do that, and it takes a long time, especially when you're looking at a long-term chart like this. It takes a long time to get there, but if we did get there, I think that would provide an absolutely fantastic selling opportunity in the bond market. But just to reiterate one more time, this is bearish, right? We have a down move. This is a bearish wedge pattern, long term, but a bearish wedge pattern that ultimately is going to play out to the downside, regardless of whether we get to 159, 161. It doesn't really matter. It's going to ultimately play out to the downside. And again, it's not a bond market lesson. It's just a chart lesson. All charts are the same. And the dollar, we got a tiny uptick today. Long and wrong the dollar still. I stayed in the dollar. I am still long the dollar. There's just too much chart support down here to leave the party. I don't want to be the last one to sell the dollar down in this area where there's just a ton of chart support. Even if we got to the 200-period moving average, eventually this dollar is going to take off to the upside. And when it does, it will likely move hard and fast. And so with all the support we are from a long-term perspective down here, I'm just reluctant to get out of the trade. And that's just, maybe I'm a little stubborn, and that's okay. I have good reason to be. There's a ton of chart support down in this area from a long-term perspective. So I am stubborn with the dollar, but I have a reason to be stubborn. I'm not really trading on hopium with the dollar. I have a lot of chart support from a long-term perspective, and I'm okay with having time. I have time on my side. It doesn't have to happen overnight. I know the longer-term picture for the dollar is higher prices. And with that, I'm going to wrap it there tonight. It's everything I wanted to discuss. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.